22-18, multinational transfer pricing, effect of alternative transfer pricing methods, global income tax minimization. So user-friendly computer, so UFC, with headquarters in Nepean, Ontario, manufactures and sells a premium desktop computer system. UFC has 3 divisions, each of which is located in a different country. So we've got China division, manufactures memory devices and keyboards. South Korea division assembles the desktop computers using internationally manufactured parts and memory devices and keyboards from China. So we're transferring down. And then South Korea ships it to the Canadian division, and the Canadian division packages and distributes desktop computer packages. So they sell them to the external market. Each division is run as a profit center. The costs for the work done in each division for a single desktop computer system is as follows. So we've got variable costs in yen and fixed costs from China, South Korea, and the Canadian division. Then we've got the income tax rate. The Chinese income tax rate is 20%, South Korean is 20%, Canadian is 30%. Each desktop computer package is sold to retail outlets in Canada for $3,200. Assume that the current foreign exchange rates are as follows. So 8 yen equals $1 Canadian, and 1,200 won equals $1 Canadian. Both the China and South Korea divisions sell part of their production under a private label, so they can sell externally, right? They don't have to sell to the Canadian division. Well, China doesn't have to sell to South Korea. South Korea doesn't have to sell to Canada. The China division sells the comparable memory keyboard package used in each UFC desktop computer to a Chinese manufacturer for 3,600 yen. The South Korean division sells the comparable desktop computer package to a South Korean distributor for 1,560,000 won required. Calculate the after-tax operating income per unit earned by each division under each of the following transfer pricing methods. Market price, 200% of full cost, 300% of variable costs. Income taxes are not included in the computation of the cost-based transfer prices. And then which transfer pricing method or methods will maximize the after-tax operating income per unit of UFC Inc. Okay, so I've done this right here because in order to do this analysis, we have to change it into Canadian dollars. So remember, it said that it is 8 yen. So we're going to take each of these numbers and we're going to divide it by 8. There we go. And that'll give us the Canadian dollar equivalent. So we've got this and we're going to divide it by 8. So this is Canadian. And we're going to do the same thing right here. Awesome. Now here it is 1,200. And I'm just going to copy this. And of course, this just is the Canadian, right? So I'm going to put it over here, just so I've got it all in one place. Okay, so now what we want to do is we want to take these different transfer prices and we want to calculate what would happen to the transfer price if we were charging, the market price. So if we were charging the market price, so here we've got A. So if we were charging market price, then we know that China to South Korea would be $450. And we know that South Korea to Canada would be $1,300. That's the market price. If we do item B, it's 200% of full cost. Full cost, of course, is both the fixed cost per unit as well as the variable cost per unit. So over here, I'm going to copy this down. So in this case, it would be the variable cost plus the fixed cost, $350. And it says 200% of full cost. So I'm going to take this and I'm going to put brackets around it. and I'm going to multiply it by 2, it's $700. Now, South Korea, don't forget that we're going to charge 200% of full costs. So full cost, this is South Korea's variable costs and fixed costs, but South Korea also has to pay the amount from China. So in this case, we're going to take the 700 plus the 300 plus the 400. Okay, we're going to take all of that. We're going to add it all together and we're going to multiply it by 2. Now, why am I including the 700? Because these two costs right here are only the variable costs and fixed costs from South Korea division, what the South Korea division is doing. But on top of that, Canada will have to pay the $700 because that $700 is going to be transferred to South Korea. South Korea is going to pay it, and then they're going to transfer that charge to Canada. So in this case, it is $2,800. This is all Canadian. I want to remind you that this is all Canadian. All right, so now we're doing item C, and this is 300% of variable costs. And again, I'm going to just copy these two down. Okay, so if it is variable costs, here we've got the variable cost, we're going to multiply it by 3 or 300%. That is $375. We're going to take this variable cost, which varies with the level of purchases, right? And I'm going to take this variable cost, and then I'm going to take those two and I'm going to multiply it by 3. And that is $2,025. And all of these are Canadian dollars. So I'm just going to go like this. There we go. So that would be the transfer price at these 3 different methods for transfer pricing. So now, what does it say next? Which transfer pricing method will maximize the after-tax operating income per unit for the UFC Inc.? So now we're going to take that information and we're going to calculate how profitable each division is, right? So we're going to go over here. Now, we're going to start, of course, with China. We need their revenue per unit. And we know China's revenue per unit is going to be $450 because this is the transfer price. They're going to transfer this to South Korea at $450. So they're going to earn $450. They also have their variable costs. So let's just copy it over here. Variable costs per unit and their fixed costs. So we're going to have minus the 125 minus the 225. They're going to be their variable costs. And so their operating income per unit is going to be these things added together. There we go. $100. We know that they've got income tax. And that income tax is 20%. So we're going to take this and we're going to multiply it by the 20%. That's their income tax. And so their net income per unit is going to be $80. I'm just going to put this here, put this here. Awesome. Now, keep in mind that they're transferring their goods to South Korea. Right? That's what they're doing. They're transferring it to South Korea. So I want this information down here. All right, perfect. Now, don't forget, we've got to add one additional cost here, the transferred in cost. So we've got the revenue per unit, which is 1,300. Transferred in cost is going to be the $450 because they're transferring it over to South Korea. Then they also have their other costs, which is $300 per unit, $400 per unit. And so, oh, yeah, those are negative. I don't know why they're doing different things. Let's just make it so that it's a lot easier. I'm going to do number. We don't need this. There we go. That's a lot easier. All right. So now we've got this. It's going to be $150. Tax rate is 20%. Minus, there we go. So we've got the net income from them is $120. So now we're going to move over to Canada. I'm going to take this and I'm going to copy it and I'm going to paste it. We've got the revenue that we're going to earn, $3,200. Transferred in is going to be the $1,300. Then we've got our variable costs, 100, 200, and that's going to determine our operating income per unit, 1,600. And now we got to take away our tax rate. Our tax rate is 30%. That is $480. So total corporate income is going to be all three of these added together, 80 plus 120 plus 1,120. Our total corporate income per unit is going to be $1,320. So this was based on, of course, let's just remind ourselves, market price. We can do the same thing using the 200% of full costs, right? I'm going to do the exact same thing. I'm not going to put all my labels again. I'm just going to paste it over here. And let's see. Yeah, I'm going to paste it over here. I know it's all going zero, but it doesn't matter. I've got the formulas there. So this is going to be 700. This is going to be 2,800. This is still going to be the 3,200. I can take this from over here, right? That's not going to change. I can, yep, this is perfect. So I can take this from over here. Nice. Take this from over here. There we go. So we're going to make $280. We're going to make over here $1,120. We're going to make over here $70. Total will make $1,470. Now, let's just do one more. But here I'm going to do 300% of the variable costs. So again, I'm going to use this as the selling price. Everything else should be identical. This is the selling price. Perfect. And this as the selling price. Everything else will just transfer down automatically. I'm going to make $1,393. So the fact is, if I use 200% of full cost, I am going to make the most money as a corporation because I'm going to make $1,470 per unit. So why is this happening? Like why are we getting different operating income? And the impact comes from the fact that there's an income tax. So if we look at this, this is total corporate net income per unit. Now, let's assume there's no taxes. So I'm going to do total corporate operating income per unit. So operating income is before taxes, 100, 150, 1,600. I'm going to copy this over here, put it over here, put it over there. Do you see that? The total corporate operating income per unit before taxes, they're all identical. All that we're doing is shifting. So I get $100 here, $350 here, $25 here, It doesn't matter. I'm just shifting the profit to another department. Only because of different tax rates do we end up with different net income. And we end up with more net income here because we are placing the highest operating income in the lowest tax jurisdictions, the lowest tax countries. So by putting the majority, because you got to think the total operating income here is 1,700. So I'm going to copy this here and I'm going to do it here. Here it's only 250. So I'm paying taxes on only $250. Here I'm paying the lowest tax rate on $1,750. Here I'm paying the lowest tax rate on $975. So of course, if I'm paying the lowest tax rate on $1,750, I'm going to have the highest corporate net income per unit because I am transferring the majority of the profit into a country that pays less taxes. Let's just double check that we answered everything. We answered everything. But keep in mind, if there is no taxes involved or the tax rates are all identical, so we have taxes of 20% for everybody. So let's do that, 20%. I'm going to make 20%, going to do 20%. Now look at it. Makes absolutely no difference anymore, right? Transfer prices, when there's no taxes, make no difference. All that happens is one division becomes more profitable than another division. But overall, the corporation is not better off. They are only better off when we take different tax rates into account. That's it for 22-18.